The rich know how important it is to understand the world of taxes. They use their knowledge to make money, and more importantly, to lower their taxes, allowing them to keep the majority of their earnings. Taxes can be complicated and overwhelming to understand for most regular people. Canadian taxes are no exception. That's where this video comes in. In this video, I go over everything you need to know about Canadian taxes. Watch until the end to learn how to legally reduce your tax bill and keep more of your money in your pocket. My name is Noah, and I help people understand personal finances and investments. If you're interested in learning how to take control of your money and achieve financial freedom, like this video and subscribe to my channel to see more videos like this one. Canada has what we call a progressive tax system. This is a taxation method in which those with higher incomes pay more taxes than those with lower incomes. This is intended to redistribute wealth and reduce income disparities. In Canada, taxes are collected at both the federal and provincial levels. The Canada Revenue Agency, or the CRA, collects federal taxes, which are used to fund programs and services that benefit the entire country, such as national defense and foreign affairs. Provincial taxes, on the other hand, are collected by each province and are used to fund regional programs and services such as healthcare and education. Federal tax rates are the same across the country, regardless of where you live. Provincial tax rates, on the other hand, vary from province to province. The amount of tax you pay is based on tax brackets. The tax bracket is the range of income taxed at a specific rate. When your income rises, you may move into a higher tax bracket, resulting in a higher tax rate. The highest tax rate applicable to a person based on their income level is known as marginal tax rate. Here, you can see various tax brackets for federal taxes in Canada for 2022. If your income is $50,197 or less, you fall in the lowest tax bracket. But if your income exceeds that amount, you will automatically end up in the next tax bracket of 20.5%. Now, the common misconception is that when you move into a higher tax bracket, you'll be taxed higher on all of your income. In reality, only the portion of your income that falls into a higher tax bracket is taxed at a higher rate. For example, if your total income in the year 2022 is $150,000, the first $50,197 is taxed at 15%, and the next $50,195 will be taxed at 20.5%. The remaining $49,608 falls into the third tax bracket and will be taxed at 26%. It's important to know that regardless of the tax bracket, the more income you earn, the more you will take home after taxes. Also, I want to point out that we're only using federal taxes in this example. In reality, you'll also pay provincial tax on top of this. Another factor that decides how much tax you have to pay is the type of income you earn. The majority of Canadians earn a living as employees. This type of income is referred to as personal employment income. Similarly, income from business and investment is referred to as business income and investment income. Both the business and investment income are taxed at a lower rate, which means you keep more of the income to yourself from these sources as compared to a job. You can use a free calculator from a website like ey.com to see how much tax you will pay based on the type of income you earn and the province you live in. You can enter your taxable income, and it will calculate how much tax you owe. Let's take the example of Sam. Sam lives in British Columbia and makes $100,000 a year. The total tax for someone earning $100,000 per year in BC is $21,447. This is the combined amount for both the federal and provincial taxes. You can see that the tax percentage on investment income is way less than what you'll pay on employment income. The marginal tax rate on employment income is 31%, but on capital gains and dividends, it's only 15.5% and 7.56%. On top of this, if your investments are held in a tax-sheltered account like TFSA, you can further lower your tax rate to 0. If you're interested in learning about how to use your TFSA to its maximum potential, I recommend you check out my TFSA video linked in the description. When it comes to employment income, there are ways you can pay less in taxes. By using tax credits and tax deductions, you can legally reduce the amount of taxes you owe. Tax credits are reductions in the amount of tax owed on a dollar-for-dollar basis. A tax credit is like a coupon that you can use to directly reduce the amount of tax you owe. For example, if you owe $1,000 in taxes and you receive a $300 tax credit, you'll only be required to pay $700. Tax credits are available to everyone, regardless of their income or tax bracket. Tax credits can be refundable or non-refundable. Tax credits that are refundable can be claimed even if no tax is owed. If the credit amount exceeds the tax you owe, you'll be refunded the difference. The Canada Workers Benefit, for example, is a refundable tax credit. Non-refundable tax credits, on the other hand, can only reduce taxes you owe to zero, with no refund for any unused portion. An example of this type of credit would be the basic personal amount. Now, in general, refundable tax credits are more beneficial because, unlike non-refundable credits, they can provide a refund even if you don't owe any tax. Some of the common tax credits in Canada are basic personal amount, home buyer's amount, GST HST credit, child care credit, climate action incentive payment, and Canada Workers Benefit. Tax deductions are different than tax credits. Tax deductions reduce your taxable income, lowering your overall tax bill. The amount of tax owed is determined by subtracting eligible tax deductions from your taxable income. An example of this would be RRSP contribution. When you make a contribution to RRSP, you can deduct the amount of the contribution from your taxable income for that year, reducing the overall tax you owe. For example, if you earn $50,000 in a year and you contribute $10,000 to your RRSP, your taxable income would be reduced to $40,000. This means that you would only be taxed on $40,000 instead of $50,000, potentially leading to a smaller tax bill. In order to further increase your tax savings, you don't have to claim the deductions right away. You can wait till the year when your income is in a higher tax bracket. Claiming your deduction later may lower your tax bracket and further bring your tax bill down. I discussed this in depth in my RRSP video, which I'll link in the description. Some common tax deductions available to Canadians include childcare expenses, moving expenses, medical expenses, charitable donations, childcare expenses, and tuition and education expenses. Now let's discuss why your employment income is least likely to make you wealthy and financially free. As we saw earlier, employment income can be taxed twice as much compared to income from investments. The more money you make as an employee from your job, the more you have to pay back in taxes. Income from investments, on the other hand, is taxed the least, allowing you to keep more money in your pocket. The majority of wealthy and successful people have multiple streams of income. They own businesses and invest in high-yielding securities on a regular basis. Businesses not only have a lower tax rate, but they also have several tools at their disposal to reduce the amount of taxes they have to pay. While the top marginal individual tax rate in some provinces can exceed 50%, the federal corporate tax rate is only 15% for small businesses and 26.5% for corporations. On top of that, the tax deductions available to businesses are considerably better than those available to individuals. These deductions are often referred to as business expenses. A business expense can be any cost related to running a business. These can be deducted from overall income to lower the taxable income. Examples of things that can be deducted from total income as business expenses include rent, utilities, supplies, advertising, fuel costs, car insurance, phone bill, utility bills, employee benefits, lawyer fees, travel expenses, and interest on business loans. Now, while all individuals pay for many of these expenses, only businesses can use these deductions to lower their total income. Large corporations, like Amazon, are often criticized for paying relatively low tax rates in relation to their profits. You may wonder how they're able to do this without facing legal consequences. Well, the government offers various incentives to businesses in exchange for investment or job creation in the area. Businesses are also eligible for tax credits, which reduce their overall tax liability. All in all, business allows scaling your income while simultaneously paying less in taxes. To summarize, in Canada, as your income rises, so do your taxes. The percentage of tax you pay is determined by your tax bracket. You can reduce your tax rate by lowering your tax brackets using deductions and credits. Having multiple sources of income is the key to paying fewer taxes. Income from investing and running a business is taxed more favorably, allowing you to keep more of your money for yourself. To maximize your savings, use tax-sheltered accounts such as TFSA and RRSP to allow your investments to grow tax-free. This brings us to the end of this video. I hope you learned something new and found this video to be informative and helpful. You can check out my other videos from the links in the description. Please subscribe to my channel and hit the bell icon so you don't miss out on any of my future videos. Here are my other social media platforms if you'd like to connect. Thanks for tuning in, and see you in the next video.